And again, it's morning, it's not Saturday. Again, it's actually Sunday. I'm struggling a little bit, trying to work off the hangover from yesterday night. But, in these effort of trying to keep up with this weekly schedule, weekly routine of a market recap, I decided to show up and actually try to put together a few thoughts. Now, it's probably not going to be very chart oriented. I guess the main topic of the week was, Fed power testimony and Fed chairman power testimony and new CPI data. Plus, I woke up this morning and I came to know from the news, from Twitter, from a few people on the Discord that there have been these attempted assassination on Donald Trump. Yeah, so I wonder if it might gonna be something which shakes out the market on Monday. But no, we are not gonna get into it. Absolutely, it's too long of a topic, and quite frankly, it is still it's politics. I can already see people saying it's another psyop, it's just shenanigans, which I might believe it, I might not, but my opinion is kind of irrelevant. But let's look at markets first and foremost, all right? Let's start out with Bitcoin right here. And, we left out last week, and Bitcoin was basically in here, I guess. I was trying to put together these bounds, and it looks like throughout the week it stabilized itself, and it basically managed to put together these bounds. Now, of course, this line that you see here, I drew it. I guess it was 2, 3 days ago. Same as the other one, the upper one right in here. Those are, in my opinion, potential levels of resistance now. So I was watching them closely to see how price reacts around those levels. Okay, it's not really a line in the sand. I'm just trying to grasp the market reaction around those levels. Basically the logic might be if you want to be bearish at each one of these levels, you might see the market and price, of course, doing something like this and coming back down. And I need to change my color here again. Or it could be from the upper level, something like this, and then it comes back down. Or otherwise, the opposite case, the opposite scenario, if you want to be bullish, and I'm sure my brush is going to be yellow once again, but you get the gist of it. You're going to see Bitcoin reclaiming these and then trying to push higher, kind of like these. And really, when you see it coming back above these level, right in here, it might be that that time you can say this was overall some sort of a bear trap, and now we're gonna just going higher. I honestly don't expect, even in the case if we go higher, I don't expect it to be a very sharp movement. At least as for now, we are gonna see how this price action unfolds itself in the coming days and week, possibly throughout all the month of July. But that would be the case, okay, if you want to be bullish. And at this point, quite honestly, there are reasons to be bullish here. I mean, not overconfident, not massively bullish, but a few reasons. If you consider the type of asset we are dealing with, at the amount of volatility that it can shows off, right? If you have what some folks actually define as a breakdown like that, you would expect continuation sooner rather than later. So the fact that it managed to kind of hold itself all together pretty decently here, it might suggest that we are gonna have an extended bounce here. But really, up until the point I don't see it above 64 really. I I'm still, kind of undecided on it. It could keep on ranging higher a little bit and then retest the local lows that were put in at the beginning of July, and then we see from there. But as for now, if you are bullish, just enjoy the bounce and pray is going to reclaim a few levels here and there. As for gold, we can see gold. It is just something that it was kind of. I don't want to say I called it because it's just bullshit. You know, trying to call markets up and down. But there was this pattern right in here, which was very similar to this one, and you know, quoting myself, when it looks like it's gonna go to the downside, you're gonna probably gonna see an attempt to the upside instead. This is just the nature of the asset. You know, it tends to stay in this range for a long period of time, and then eventually it makes up its own mind. So we're kind of skeptical of a drop right in here, and gold actually reclaimed the EQ here, and it looks like it's going for a retest of the current range high. So we'll see how this thing actually performs over the next few weeks. All right. Quick look at oil, the asset which is putting me a little bit on the spot right now because I can't figure that out yet. It looks like it stabilized itself a little bit this week. We had this little bit of an exhaustion phase right in here. I was having a conversation uh, with my oldest friends at this point on the internet. German guy, very smart, very clever. And we were discussing about how can you define a trading range and how can you spot exhaustion. And I was pointing out this behavior right in here, right? So when you see price getting a little bit stretched out and you see these wicks, like price is scrambling to find liquidity and find orders on both sides, right, of the current price level, but it just going up, coming back down, going up, coming back down. It looks like it's really scrambling to find it, and after that, usually you see a decent pullback. We had the pullback, we had the run up again, kind of like another attempt to go higher, and it was rejected on Friday. Now we are going to have to see how it opens up next Monday, but again, let's look at this chart once again and let's see what the break-evens are showing up. Let's zoom in a little bit. Yeah, again, we can zoom in a bit further, but it looks like the break-evens are actually keep on telling you that inflation expectations are a bit on the low side. So yeah, naturally that should bring down the price of oil with a lag by the logic of the, the, the data set in here, the indicators and what it means, and the relationships it has with the oil price. Okay, as discussed in previous videos. So we keep on monitoring it relative to the price of oil, and we are going to see. Um, so it is linked and connected to what I was saying in the beginning about the big news of the week, which is CPI. We're gonna get there a bit later on, but again, it looks like everything is kind of falling into place, right? CPI came out very weak. Well, it depends where you stand, but it was like 3%. So month over month, I guess it was the first negative print from maybe 2021. I don't really remember on the top of my head, but it was significant. This data release was actually significant. Let's take a look at the DXY. And again, this is a very macro and larger time frame type of view where you see the run up, the exhaustion, and then it pulls back and it creates this range and it stays in this range. And at this point, it stayed in it for quite a long time. It had two deviations out of the range with, every time you got a deviation out, you had a very sharp mean reversion, and actually there was this, again quoting my German friend, this mirror trade to the other side. Okay, at least in the first case. In the second one, not really, but again, it deviated out and above range high, and it came back down, piercing the range low after a brief pause at the equilibrium, at the midpoint, the EQ, whatever, and it climbed itself higher again. It tested out range high, and now we have been rejected at range high. In the last 2 weeks, we came back down. I guess probably we are going to retest the EQ once again, and then we're going to see if we want to go for a retest once more of the range low, or if we are going to chop around this area a little bit for maybe 2 or 3 weeks. We'll see. Conversely, if you look at currencies, and still you got the Dixie in here, but if you look at the pound, we were saying, it was in this trading range, it deviated out below a range low, and what was it to be expected? It was a test of the high side, high boundary of the range, and then it came back, and I said in the previous video, even if you can't really see it, but if you can imagine it, this should be kind of like the EQ, the midpoint of the range. We tested it, and it went higher. Same for the euro. The euro had a pretty decent bounce right in here, but maybe the most what deserves the most the higher attention is actually the yen. We were talking about the yen, quote unquote, was fucked at around 162, and now it came back down. Now, again, this is a little bit connected to what I was anticipating about CPI. So, could this be some sort of the currency market, the FX market is actually pricing in the possibility that these cuts from Jay Powell, so from the Federal Reserve, are gonna come in a bit earlier than expected? Because everyone was talking about September, but with this new CPI data and a little bit of the testimony Powell gave out in front of Congress, so maybe the market is trying to front run it a little bit and saying, what, maybe the old man saw something which scared him, and if he's scared, maybe he's gonna drop rates a little bit earlier than what anticipated. Now, of course, if you when you getting back to the DXY a little bit, when you look at it, it looks like some people might say this is high, low, high, might get down to the low side of the range, and at this point, who knows if it's gonna hold it. So you're gonna see the Dixie actually pulling back real hard, maybe below 100 and whatnot. Maybe. What I would say is it is totally possible, absolutely, but we always need to bear in mind that at the end of the day, the DXY is made up for the most part, as an index of the euro currencies, the European currency, and the Japanese yen. Those represents the core, the main part of the index. I guess the euro should account for like more than 40%. I guess, if not even more than that. Don't remember on the top of my head. And the yen is another good chunk of a component. And then you got minor currencies. Even if you look at how the British pound it is represented in it, it's a very small percentage. And then for some strange reason we got still the Sweden kronen. I guess it was the name of the currency. I guess the English translation would be the Swedish crown, something like it. But when you try to assess the dollar strength relative to other fiat, it sometimes is useful to check these Asian currencies right here, because when you look at them, there is the Russian ruble in here. It's still part of the, if you remember the video from 3 4 weeks ago, the BRICS currencies, right? So look at the Chinese yuan on the weekly time frame. It is still particularly weak against the dollar. Same for the Indian rupee and the Brazilian real. Now the ruble, the Russian ruble, it looks like it is getting a little bit more stable, but if you look at the long-term trend, it is still going down. So all these, again, reiterating the same old shit, all these dollar doom, the dollar is dead and whatnot. Yeah, maybe not today, right? And you know, I guess after looking at currencies, we might want to transition into bonds. And yeah, again, bonds had a little bit of a decent bounce in here, especially if you look at short-term duration. Looks like it's really going right now. The mid part of the curve is falling along, is following along. And it looks like, again, the long end is lagging a little bit. Now, again, um, we discussed the convexity and price sensitivity at the long end of the curve relative to the short end. So I'm not gonna redraw well, basically these, right? Highlighting the percentage move and comparing one to the others. But even looking at them like this, if you see the short end is going up faster than the long end, of course, what you could naturally grasp is that we are seeing a little bit of an inversion, right? Because you do know there is an inverse relationship in between the price of the underlying asset and the yield on it. So, but again, as I said, people have been calling for these on inversion many, many times, and there were times where we were particularly close to it, and then it didn't come. So might be, third one is the lucky one. Of course, lucky, it depends on where you stand. Of course, for me would be, but I guess for many other people it wouldn't, because usually when you have something like this, which is basically, a bull steepener, okay, and it's a little bit counterintuitive because it contains the word bull, bullish, but if it is bullish for bonds, it is basically bearish for many other different things like equities in the first place. So just pay attention to the context in which these terms are used. Generally speaking, bullish for bonds, it's not good for the other risk on assets. So you know bear it in mind. Um, and now we got, of course, the indices futures. Particularly interesting week. If you look at, let's say the Nasdaq started out on Monday going up, it pulled back a little bit on Tuesday, and then it went up Wednesday, and then on data, on CPI release, we got this Thursday reversal. It was a very sharp reversal, actually. It tried for a little bit of a bounce on Friday, but it looks like just, at the end of the session, the bounce was negated. And the same behavior can be observed in the ES futures. Again, the Dow, I'm not I'm not calling it names this time, but the Dow, it looks a little bit decorrelated from the others, and it might be a little bit more evident if you look at it like this, right? You see these one and two, these two, they start to show a little bit of an hesitation, maybe. Why the Dow is actually going higher? Yeah, it's closing the week on a pullback, but if you just look at this segment of price action, it looks like the Dow is getting a little bit of attraction compared to the other two, at least these past week. And again, I'm not saying, well, I will put all my eggs in the Dow's basket, but who knows? It might be again a little bit of a market rotation, although we are a little bit, the quarterly close is very past behind us now. So I think that that argument is actually losing steam a little bit here. Finally, let's check the ETFs, so the triple Qs and the spiders. When you look at them, it looks like, at the current moment in time, SPY is a bit stronger than the Qs. So you see, the engulfing on the daily, and then we got Friday, which tried to reclaim the previous range before the drop, and it was rejected right in here. Fascinating. I mean, it was really precise. And instead, the spiders, they didn't come down quite as violently, but it was, I mean, if you account for the different volatility measures in these two, they came down sharply. They tried to go higher, and they were spider spider was rejected at this level. So I guess nothing is broken, right? Again, don't let a week, a day, 2 days, 3 days of price action to throw you off your general bias or let you discard the overall trend. We are still well above even the 20 days moving average right in here. So if you remember a few weeks ago, well, a few weeks, a few days at this point, we actually retested it and then we were off to the races. So, you know, if you look at where especially on this on SPY, if you look at where the moving average is, and it matches up particularly nice with a very structural support now. Would it be bad to see both of them actually coming back down, testing the moving average and shooting back higher? No, I think it would be particularly natural. So I guess there is no damage done in these, and you can stay particularly Safu for now. But getting back to the news of the week, CPI, the read was 3%, and at this point it looks like we had the exhaustion, we had CPI picked up, and then it came back down quite sharply, and then it became a little bit, as the man says, sticky, so a little bit of a sticky inflation. I think when you start to pair it up with a lot of different data, especially the unemployment rate, which is sticking up around 4.1% now. This is looking like disinflation now, and therefore uh, what we were discussing about the currency market and the bond market, the potential third attempt of an inversion, it, it could be the market is really seeing this disinflationary wave coming in. And even if you go to CNBC, if you look at what Powell actually said, you know, it looks like he really wants to cut. And I don't know. I mean, of course, it, even with all the disrespect and the lack of trust you might have in policymakers, because you do remember all the story about there is no problem in here, and then we was now we got inflation, but it is transitory. Oh no, it is not transitory. So we need to hike rates at the fastest pace in history. And then it was like, yeah, we're gonna stay high for longer, and they did actually. I mean, it was uh, a few months they stayed higher for longer, and of course now it's like he's preparing the markets for what is about to come. Again, we don't know if it's going to be July or if it's going to be September. And then before end of year they're going to cut. So the question has always been if they are going to cut, let's say 2 times, 3 times, 1 time, right? I remember at the beginning of the year the market was pricing in 7 rate cuts or something, and then it went down to 1, and then it came back up to 2 and back to 1 again. So, nobody was really sure because I think, at the end of the day, Powell himself is not sure. You need to be a little bit fair with these men. I often talk these people down and I say they're not really in control, they don't know what they're doing. But if you try to put yourself in his shoes, this is not an easy task. I mean, you got data which, they are lagging at the very best, if not completely faked and cooked and corrupted. Okay? Then, of course, although you might think you are an independent type of institution or agency or whatever, it turns out that one way or the other, you are a political institution because if you cut rates, especially now, so getting into the election, it could be that could it be the old man is actually trying to help out the president, which is currently in charge, because at the end of the day, if you look back, there wasn't a good relationship in between Trump and Powell. So, oh man, if this guy is coming back in the office, it might be that he fires me, right? Last time we talked, he kind of called me a clown because I was keeping rates higher. And it was what, 2018, 2019. He actually said, the central bank would need to lower rates now. Then, of course, we got the pandemic, the elections, and Trump got out of office, Biden came in, and the rest of the story. But whether you like it or not, you are involved in these political games. So at the end of it, it's not easy. I guess it's a nice analogy. He's walking on a very tight rope right now because on one side he can't really uh, unbalance itself, quote unquote, or leaning toward one side or the other from a political standpoint. On the other hand, he got his own technicalities to take care of, like it it kind of faded out a little bit recently, but there was this narrative about Powell and his legacy. He wants to be remembered as Paul Volcker and not as Arthur Burns. So he don't want to cut too early because he's scared that if he cuts too early, you might have inflation expectations getting entrenched, and now you're going to have runaway inflation, which, by the way, to me personally, it's never going to be the case. I mean, I don't think it's going to be the case. Not for the next 5, 10 years at the very least. So, and on the other side now, you are going to see him pivoting a little bit, saying, yeah, we wanted to stay high for longer, and we actually did. And now we're seeing the improvements in the economy we wanted to see. So the labor market is softening, inflation is coming back down to our target and whatnot. Um, so it might be a good moment to cut. It's not so in proximity, so near to the actual elections, and at the same time, seeing the unemployment rate ticking up at 4.1%. I'm seeing inflation coming back down sharply at this point. So I got reasons, right? I guess if you would have from here to the end of the month of July a little bit of a crack in the, dare I say, the commercial real estate market of the banking system, that would be the catalyst, which absolutely would give him the green light to cut. Although, he paradoxically, I think, and this is just my personal opinion, he should have cut way earlier than that. And I'm gonna tell you why, at least from my perspective. All right, I'm not saying this is the absolute truth, okay, but from my perspective, at the very least, because I think there is this lag effect, okay. So I guess he's right when he talks about the data which are not really reliable, okay. And I talked so many times in the past videos about the data being cooked for whatever reason, okay. It might be political, it might be just for this psyop, right? Because if you convince people that the economy is good, they're gonna act like the economy is good, so they're gonna spend and then gonna actually prop up the economy. On the otherwise, if you start saying people that the economy is bad, they're going to act as the economy is bad. So they're going to cut spending, and they're going to be the same cause of the recession to come, and you don't want that. So at the end of the day, I guess it is true what I don't remember if it was Bernanke or I guess it was Bernanke, but I guess he said that when he was no longer chairman at the Fed, and he said, central banking is 10% technicalities, 90% talks. So it's a continuum of psyops. Because at the end of the day, I guess you need to look at both sides of the argument, and saying sometimes they come at you as protesters, as a little bit arrogant, as they know everything they need to know and you know nothing. But at the same time, if you want to be fair, they don't have the tools, right? I think they don't have the tools. If you think that in order to manage an economy or a financial system, everything you got is rates, and what? And Fed balance sheet? And you are discarding completely, you are completely discarding everything else is going on in the financial system, in the shadows, in the euro-dollar system, in the shadow banking, in the currency market, and offshore, so outside of the US. So it is beyond your reach, it is beyond your jurisdiction. And even if you wanted to, you don't have any title to go there and impose some sort of regulatory framework. And at the same time, the private sector, the banking system, can act in ways which can bypass your regulatory framework, even in the US. they just go offshore, right? So it is really hard to do the job they are appointed for. But as the good old saying goes, it is a hard job, but someone has to take it. So good old Powell. What can you say about him? It is just the history which is repeating itself about central banking. It's a great idea. It works in theory, but then it just doesn't. So you know, and people might say, there are very different narratives. Are we in the 70s again? If the old man cuts too early, we're going to see a reignition of inflation, and it's going to be like in the 70s and 80s. No, I mean, again, it is just my personal opinion, but I do think we're not. We're not because the underlying conditions are not the same. You're not seeing this willingness of the banking system to extend credit. And the bond market is actually telling you the banking system is actually leaning more towards safety and liquidity. They're trying to shield their balance sheets for the shitstorm they see coming. Because if you don't have access to reliable data, you might be a bit more sure than these guys which have skin in the game. They do actually see it. So, they see the risk, that they see the potential discrepancies, they see the cracks because they can touch them firsthand. But you can't. Me, as a general citizen, and nor even Powell. So, again, at the end of the day, when you think about inflation, the rate of inflation, and therefore the corresponding type of a level of nominal rate we should have, look, at the end of the day, what I think is yields, and therefore rate, are just a reflection of future growth and inflation expectations. So when you see rates going down, that is basically the market saying we don't think we're going to see growth in the coming years. And even if you think about the simple phenomenon of yield curve inversion, I mean, if the long end is going down, that is the market telling you they don't see growth and inflation coming on. But at the same time, you see the short end being, you know, higher than the long end, and that, the short end is much more impacted by policymakers' decisions. So again, it is the market calling them out and saying, look, you think you need to keep rates higher for longer, but the reality we are seeing here in the market, because we are the market, it is that there is no need for it, which is why we are bringing down the long end of the curve to signal that over the coming years, you're not going to see the inflation you think you're going to see. You're not going to see the growth you think you're going to see. So there's no need for you to actually be so aggressive in tightening financial conditions. Now, it is true, right, that this cycle has repeated over and over again throughout history. You see, the Fed is jacking rates higher, and what comes next is usually a recession, a crisis, financial hiccups and whatnot. But this is just the way it is. We do live in a debt-based economy, and so you can have higher rates for so long before the debt burden actually starts to bite you. And people now talk about the deficit. Well, of course the deficit in the United States went higher. They took on a hell of a lot of debt, and at the same time they jacked up rates. So the impact that the interest payments on that debt, the new debt created as now, is much higher compared to when you had, let's say, 1.5% rate, right? So it's obvious, right? And at the end of the day, rates will have to come down. The deficit is going to be a problem, but what I do think is that it's not going to be a problem, not now, not tomorrow, not next week, not next month, and not even next year. And if you want to have a good counter argument for all these doomers perma bear about the deficit, the U.S. economy, the U.S. dollar, just look at Japan. I mean, I'm not saying Japan did great over the last 20 years, but sure as hell they didn't go down to hell, and they have much more debt than the United States, and they do not have reserve currency status, and they're still alive. Now they're not living out, they're not living up to good standards, either financially or economically, absolutely, but they didn't literally go bust when, yeah, go bust yet. So these things take time. So you need to remember that no matter what you think, there are many tricks up the policymakers and authorities' sleeves. Just think about the BTFP. You know, you saw SVB, First Republic Bank, and the other one going down, and everyone thought about, okay, this is 2008 altogether. Well, you know what? Just set up the BTFP, and we're gonna buy this shit a few a few more months to go ahead, at least 1 year. Now, of course, the BTFP came to an expiration, and now we're going to see what's going to happen. But it's very easy to call for the next crisis and then seeing it kick down the road for another 1, 2, 3 years. You never know. So again, just pay attention to it. That was pretty much all I had to say. Um, I don't think there is really need to talk about anything else. People will be glad to see that I'm not going to talk for 1 hour, but I'm going to keep it at the 40 minutes mark for this time, right? And yeah, basically because the market, as for price action, it didn't really move in a way which was so deviated out from the expectations I had, and I wanted to expand a little bit on all these talking about the new CPI release and a few touches on topics here and there, like yield curve, deficit, and whatnot. As you heard, we could talk a little bit more about real rates, or how getting back to the data which are faked, how the data are corrupted, and how and why they lagged, but it would take too much time. So maybe in another video, but not now, correct? Okay. So as for the rest, enjoy the rest of your Sunday. Have a good day, and we are gonna see what's gonna happen next week with the following weekly recap. Peace out.